Please welcome the panel on Private Credit Cashing In, moderated by business and finance editor of Semafor, Liz Hoffman.
Bright lights.
Hi, everyone. Thanks for coming. Thanks to our panelists. Good chat. I don't know you all, but private credit has been the thing that I've heard the most about in the past 48 hours or so. So this is a good crew. Let's start high level. Ted, we've had, maybe a trillion and a half dollars of this stuff out there, a lot of which has come in the last 5 or 6 years. We've got it resetting at higher rates. Looks like we're in a higher for longer environment with some pockets of maybe slower growth than people had expected. What's the outlook here?
That's a good question. This asset class has probably grown at a 20% CAGR from the financial crisis. Goldman Sachs, I read a report last week, expects it to grow at another 25% CAGR over the next 5 years. So it's been a cool place to be. We've been doing this business for 25 years. It wasn't cool for the last 15. All of a sudden, pension funds, insurance companies, sovereign wealth funds, lots of different investors have realized that current return is a really good thing to have in their portfolios. And we were fighting for 1-2% allocations for most of the allocators, and we're seeing a lot of the pension funds now at 15% allocations for this asset class. And what we've learned is that private credit is a really big asset class. There's a lot of specialization pieces within it. And just amongst ourselves here on the panel, some focus on the upper end of the market, the traditional kind of market. We like the lower part of the market. And I was telling James earlier, kind of 40 million EBITDA size companies and below is where we like to play. And the reason why for us is that, one, I don't have to compete with all these Wall Street firms. But really, the reason that I like it is that it's much more inefficient. And we don't see as many players there. We're a relatively large player in our space, so we can speak for lots of the capital stack. We can hold up to 250 million, 300 million in a transaction. And the pricing's a little better, the leverage is a little less, and the documentation is a lot better. We don't see covenant light loans. We don't see PIK toggle. We don't see the ability to grab assets and create, unconsolidated subsidiaries. I talk to a lot of my friends that, run businesses. We have just different issues. Ours is really origination. It's a much harder origination. I have 8 offices and 23 originators chasing around the US looking for deals. So I'm very bullish on the business. And I think the best is yet to come, although there's going to be a lot of consolidation, I think. And I think others will say that the lines between the syndicated market and the BSL market and the middle market have blurred. And I expect that to continue to happen.
Yeah. I mean, James, you work at a bank in the asset management division, running private credit in London at Goldman Sachs. Talk about that a little bit, that convergence that we're starting to see. And I think what started out perhaps as more of a competitive environment, it's occasionally collaborative, a little symbiotic.
Yeah, maybe we're a little bit different as well. I mean, we started in private credit in 1996. So it's been almost 30 years. And when you actually reread the memo at the time of launching our first, it was a junior direct lending fund. The idea was, one, we wanted to be the lender of choice of private equity, and private equity was going to grow. But also, we at Goldman Sachs are in the middle of this ecosystem of deal making, and we wanted to leverage that ecosystem. And so, if you fast forward, to today, this is very much true. I would say that's part of the secret sauce of our direct lending and certainly private credit platform, which is that we're 200 investors globally, but we have over 3,000 bankers. And they're constantly in dialogue with companies of small cap, large cap, mid cap. They're in dialogue with private equity sponsors. And so to be in the middle of this dialogue for us is really critical. We work very well with our leverage finance colleagues, and so depending on the market environment, there will be situations in which we directly compete, situations in which we complement each other, a situation in which they may underwrite part of the capital structure and on the senior side, and maybe we'll invest on the junior side. And so I think the relationship that we made work with Goldman Sachs, something that is pretty special. It's not easy because effectively, if you think about what we're doing on the direct lending side, we do compete head-to-head with some of our activities at Goldman Sachs on the banking side. But that's really part, I would say, of the culture. And as you grow up in the firm, I've been doing private credit investing for 24 years. This is something that has worked very well for the firm. Now, stepping back maybe because that's a question we keep on hearing about, do we compete as an industry or do we team up, and what's the role of banks and direct lending or private credit? I think there's no doubt that we're going to coexist. Right? I mean, this panel, and this is an asset class that is here to stay. We're going to coexist. There will be markets in which, frankly, the penetration and the market share of private credit is very high. 90% plus if you look at the second half of 2022 and 2023. Banks are back. It's good because it means also M&A activity is coming back. So yet we may have to give a little bit on the returns and on the premium that we can charge those borrowers, but on the other hand, we're seeing a lot more activity. So I think that coexistence is here to stay. And by the way, I mean, we also raise financing from the banks on kind of our vehicles. And so it's an ecosystem that needs each other, no doubt.
Danielle, when you're talking to borrowers, and there was a period there, 9 months, maybe a year, where the bank loan market was basically closed and private credit was the only place to go. And I wonder how much of that, just from a sort of a loyalty perspective, almost will stay versus 9 times out of 10, the bank loan is going to be cheaper. So when you think about sort of how you're competing and what you're leading with, particularly when you're up against the syndicate.
Yeah, sure. Great question. So at Oaktree, we invest across the capital structure, both private and public, which I think helps us have those deep relationships and be able to flex as a lender. But on the private side, I mean, it's pretty spectacular 18 months ago that these banks were hung with these loans, and there is a dislocated market where we could step in at such attractive prices and actually negotiate covenants. And I think there will be pockets of opportunity like that. Today, that's not the case. And so we need to broaden our opportunity set. So in addition to more traditional sponsor-backed lending, we are tapping into our sourcing and origination team, as Ted said, having conversations where we can have a sponsor-less deal and we can directly originate. And those deals have tightened too in terms of terms, but there are niche areas that I think are still untapped. We were talking about life sciences earlier. I love life sciences because it's uncorrelated to GDP risk. It's high barriers to entry. You need people on your team that actually understand the science. And you're underwriting these companies for how well they execute and commercialize on the science. When it comes to structuring those types of loans, you can do things like delayed draws that are tied to FDA approval and whatnot. So I think that'll be an area that we continue to mine for opportunities until there is more of a dislocation and the banks do pull back. It's going to be that push and pull, especially with the rate environment oscillating between, are we at peak rates? Will they come down this year? You get those pockets of volatility.
Right. I mean, I think what you're saying is that it's really nice when your competitors sit out of the market for a year. But also, this industry was built in a time, particularly late 2010s, when the BSL market was pretty competitive and generally, I think, led with certainty, service, workout ability. How have those promises, do you think, aged?
Yeah, I think the private market is a great place to work through situations. I do, and there's going to be more of them because when those loans were originated, they weren't contemplated with SOFR above 5%. And so what I think that's going to do is that's going to broaden the opportunity set for rescue financing. That's another area that we have been very involved in. In particular, coming out of COVID, there were a lot of opportunities to do these types of financings. We did $1.25 billion loan for LATAM Airlines, the largest airline in Latin America, helping them through a debtor in possession bankruptcy. So there's those big opportunities, but today we're still able to deploy capital because there are a number of companies, as I said, that have these unsustainable capital structures. So coming in with size is really key and acting quickly.
Yeah, go ahead.
Just to give you a stat, this year, in the first 4 months, we've deployed as much as the whole of last year.
Say that one more time for the crowd.
This year, we have deployed globally as much in the first 4 months as the whole of last year. And yet, the banks are back. And so I think the point that we're making here is that the certainty of financing, the speed of execution, customized solutions, no need to do a rating, as you go into Europe, different currencies, so that flexibility, and also knowing your lender is something that really does matter, not just to the management teams and the borrowers, but also to the owners of those companies. And so even as we see the banks come back, I think you're going to see private credit continue to thrive.
Yeah, if I could jump in on that one too. I mean, private credit, when it's at its best, is solving problems that the syndicated markets aren't equipped to solve. Right, and I think you were commenting on some of that, Liz, James, you and Danielle were both saying the same thing. That's the opportunity we're seeing too, right? And there's for a U.S. economy that's in plus territory, an equity market in the S&P that's at record levels, there are more problems below the surface in credit than a lot of people realize. It shows up in the syndicated markets, right? It shows up in default rates. And so a default doesn't mean the same thing it used to mean. But when we look at default rates, I mean, here's a stat that we've focused on. In 2023, in syndicated loans and high yield, if you take the number of issuers, so you're not disproportionate to the big guys, you include selective defaults outside of court, distressed exchanges, default rates were over 4.5%. They were more than double the year before, right? It's a multiple of what you'd expect at this point in the cycle. And that's an opportunity for private credit to solve. And, our lens on the SVP side is opportunistic credit, buying in the distressed debt, right? But that's just the tip of the iceberg. Given all of the challenges out there in leverage, in companies need to finance with higher rates, in patches of the economy that aren't in such great plus territory, there's private credit opportunity to go and lend to those companies. They can't go to the syndicated markets, and the returns for that are attractive. And what you're providing there, and in buying debt and lending under your own documents, that's the value that this market brings, and that's very different than just being able to expand in an off year when your competitors are sitting out the game. And we love that too, but this is more structural.
Is there something that's just always going to be financed in the public markets? It just always makes more sense. It'll be cheaper, structurally sounder?
Absolutely. I mean, we're a private equity sponsor too. We control 15 companies. And we love borrowing in the syndicated markets when we can. It's big companies that are less levered, that are a simpler story. Absolutely. At the end of the day, CLO funding mechanisms for those loans, right? The high yield funding mechanisms, they're cheaper, right? That's going to be a cheaper cost of capital than any of the fund structures that we put in place. And good. And that's where those loans should belong. Private credit has a different role to play.
Where I think the opportunity is, right, is in the middle market. And Ted alluded to this a little bit. We can talk about the large companies that are going to access the public market. But in the middle market, there's about 200,000 companies in the United States that are in that definition, right? Less than 10% of those are private equity owned, right? So that means 90% of those are getting them in the traditional kind of commercial banks. They've gone to the bank market. As the regulatory environment continues to get tougher on those banks, these companies still want to grow. They want to take on leverage, not to the same point that they want to take on leverage, that a sponsor wants to take on leverage, et cetera, but they need leverage more than what a bank can do. And I'm going to date myself when I remember the term loan B market. Remember the term loan B market? I mean, that's what direct lending is, right? It's just now there's no A in front of us for the most part. But it was always known as the non-friendly people. But there are a lot of companies out there, PGIM being one of them, where we have feet on the ground, we have a network in place, And we have team leaders that are calling directly on companies. We've been doing this for years, for decades. And so we become kind of that bank alternative within the markets. And I think that's a huge opportunity within the direct lending market that hasn't been tapped, because the most part of it has been with sponsor finance.
We'll talk a little bit more about insurance later, but sticking on that for a second, I think most people think about insurance as an LP. We're talking a little bit backstage sort of about how you think about asset origination, how you think about playing nicely with everyone in the ecosystem, originating stuff that you know is a good fit for the liabilities you've got, but also sort of maintaining some optionality to play in other places. Talk a little bit about that.
Well, I think that was unique with our situation, right, where we had Prudential as our primary type of investor, right? But then we set up, a long time ago, we decided that we were going to set up these regional offices that I talked about, right? And so as a result of that, we had all of this connectivity with all of these companies, but we had really one product originally, right, which was, private placement. I mean, when I joined an insurance company, I was like, oh, an insurance company, oh, exciting, right? Like, it's all men in white shirts, and this is going to be really exciting. Who knew that it was going to be the talk of the town in 2024? But we just had one product, and we were limited on that product because of the liability side, right? Over time, you realized, wait a minute, I could be originating a lot of different other type of assets here if I had different assets different arrows in my quiver. And so that's when you kind of morphed from just, oh, I'm wholly owned by an insurance company, to, no, I need to actually raise third-party money, and I need to have different pockets of money that I can sell to these other companies.
Yeah, that's one of the biggest innovations, I'll call it, in the private credit business. Everyone is really focused on the growth of the industry and the assets, but what most people don't realize or focus on is the liability side. And what we've been able to do is over the years, we clearly weren't this way 20 years ago, but we've gotten a little smarter over time, is we've learned that diversification of your funding base is very important. And we were 100% institutional at one time. Insurance companies were probably the smartest investor class. And back after the financial crisis in 2010, 11, 12, lots of the insurance companies kind of rushed into private credit as an asset class because it was the only place that proved that it was uncorrelated with real estate and private equity and gold and commodities and everything else. Insurance companies came in, and then once the insurance companies came in, what happened was the consulting firms for the pension funds noticed that, because they follow what insurance companies do generally. And then the pension funds came in a big way. And then kind of 2012 to 15 to 18, we saw a ton of pension funds come in. And then the last 5 years, what we've seen is that the kind of the next frontier has been high net worth investors, individual investors, retail investors, people like us that couldn't invest in sophisticated products that were only available to the big institutional investors. But now, if you look at every wirehouse, every independent RIA firm, every wealth manager, they've got a cadre of private credit products on their platform. And for us, that's one of the fastest growing areas of inbound capital for us, is the retail side.
But then this becomes just a fight over shelf space, basically, right? And these wirehouses don't want to diligence 500 credit funds a year. They're not really set up for that. So how do you think about, other than, I guess, just being better than everyone else, how do you get on the shelf?
It's a massive fight over shelf space. I mean, I'm competing with James at Goldman Sachs. We've got $500 million of capital from Goldman Sachs, and I tell them, don't give it to James, give it to us, because my returns are better. So we've got to fight it out, hand-to-hand combat every day based upon returns. Yeah. And I'm sure you guys see the same thing.
The pie is growing, though, right? The average wealth investor has maybe 4% of their allocation in alternatives compared to a pension plan client with 25%. So I think the shelf space is growing, especially as new types of products are introduced. So I feel like VDCs were really the first way for these investors to access private credit. Today there's also interval funds, similar, but you don't have to deal with subdocs. They're management fee only. So I feel like there's new innovations that are going to grow the pie and make it a little less competitive for all of us.
But also, I think you're probably taking a US view here. And as the only maybe non-US on the panel, for instance, in Europe, these open-ended semi-liquid vehicles on the credit side, there are just a handful of them, right? And so, you know, the US was on these kind of trends a lot earlier than other regions, but I think we're seeing growth in other regions and providing those products to investors, by the way, to global investors for those solutions. By the way, when you ask the question around private credit and the growth of private credits, I think there are three things that are happening. Clearly, the banks have been under pressure, you know, from using their balance sheets and a lot of constraints, and we saw that, you know, clearly in the GFC. When I started in 2000, you know, the banks would usually underwrite and take and hold. Right, and hence that's why we started on the junior side of the capital structure. The second thing that happened is borrowers figure out that this is a great solution for all the reasons that, you know, we're discussing here. We're solution oriented, and the owners of those companies do understand it. But the third thing which has happened in the last 10 years is that we as an industry are creating solutions for the investors. You know, again, when I started, we had one junior fund. Back in 2007, we brought in a senior direct lending fund. We had 2 funds. And then suddenly, you know, now we run over 60 vehicles, levered, unlevered, regional, BDC, public, private, open-ended semi-liquids, SMAs, right? And all these vehicles, whether, you know, the underlying investors are insurance companies, pension funds, sovereign wealth funds, wealth management, retail, you have a product for this group of investors. And I think that is also fueling the growth of this industry.
Yeah, I mean, to jump in on that, so of course the returns are important, right? We put them at the front of the pitch book for a reason, and we'll always fight it out, you know, for that. But there's a differentiation here. There's a specialization that's happening increasingly across private credit, and it's something that our, you know, investors, allocators are asking for and looking for, and that's been our experience. And we were relatively early to start raising private credit funds, definitely in the special situations space. You know, we started 15 years ago. We didn't call them private credit funds at that time. Right? The term wasn't being used for opportunistic. But what we found was the LPs, over time, we started to get more and more of the big US institutional LPs, the big European institutional LPs, and they weren't moving into this opportunistic area of private credit first. They'd start with the big stuff. They'd start with the simple stuff, right? They begin with direct lending. We have a ton of respect for what those firms are doing. But as they had that product and they understood it, they began to see the benefits of complementing that portfolio with something different. And that might be middle market, that might be opportunistic in our case. And we continue to see that trend, right? We continue to see that trend where it's, as Danielle said, it's absolutely a growing pie from an allocation perspective. And it's a pie in private credit with more sophistication, more complementary specialization inside of this asset class going into the mix to create that risk-return allocation that the LPs are looking for.
I think it's interesting because differentiation is the way to set yourself apart. Returns are very difficult, right? Most of this is we started in 2010, right? That's where a lot of everybody's history goes back to, and we've been in a pretty benign credit environment, right? We can talk about COVID, and I'm not even going to go there because you have a whole book on COVID, so there's a plug for your book.
$6 trillion from the government solves a lot of problems. You were not needed, as it turned out. But,
right. And so, but you know, that flood of liquidity that came in, it was a blip, right? So it's been pretty benign. So if you line up the returns, they're pretty similar, right? Regardless of how you differentiate yourself, but you're going to see a divergence in that as soon as we hit a cycle, right? And you're going to find like who has that differentiation within their book. And in my view, one of my view is kind of origination of unique asset flow is one of the key differentiators. And that means you have a combination of sponsor flow, and you have a combination, and then the other side is non-sponsored flow. And that allows you as a fund manager to have a bigger funnel. I saw another person talking about a funnel today, but a bigger funnel, more opportunities coming in, more selective in your opportunities, but more importantly, you're not just reliant on the M&A kind of cycle, and so you can consistently get your capital deployed, which is the key to these retail products, right? You have to get your capital consistently deployed.
Just to rebound on this, I think dispersion is bound to happen. To the point, and you mentioned defaults in the US. I'll give you one stat in Europe as well. There were 84 debt-to-equity swaps in the last 5 years in Europe. You know, that's really kind of under the surface. This is happening, and 39 of them happened last year. So there's going to be dispersion. The allocators are going to see who's been underwriting properly and who has been, you know, taking more risk. I think this is good for the industry. The LPs will be able to discern, you know, kind of the differentiation amongst these platforms. This is happening.
Yeah, I think it's been hard so far, at least from my humble seat as a reporter, because there's less transparency. Certain places you can see a lot, actually, but the incentives are a bit different, right? Like private credit funds are largely in control of their own default rate. Not necessarily all the time, but there's fewer forced defaults. You know, it's like very loud syndicate making noise behind you, which was a feature, not a bug of this product, that when things go bad, you're going to sit across from us and we're going to work with you. But the upshot of that is that there's not a lot of incentive to call a default, right? So I'm curious sort of how you guys think, Ted, we haven't heard from you in a little bit, how you think about those incentives where the flexibility is such a feature, but also creates a lot of gray space.
Yeah, you know, it's defaults sounds easy. Something's default, something's not default. The challenge is, in our world, defaults can be waived, can be cured. There's different ways that sponsors have negotiated to take what would be a default out of a default situation by curing it, by putting up cash, by buying down EBITDA, by buying down leverage, by creating additional subordinated capital behind a transaction. So, you know, the interesting thing, you mentioned a word, selective defaults. I didn't know what that was. We've got a big CLO business, and what happened during the financial crisis scared the crap out of me because, you know, we were managing our book, and we knew what defaults were. And default was when someone didn't pay you. And then it kind of moved from performing to non-performing. But with rated credits, and you know, middle market has both rated and unrated credits. The large credits tend to be rated. We had probably a 250 name CLO book that we were receiving from the rating agencies every day, default notices. And these were companies that were performing. They just were trending the wrong way, so the rating agencies created these selective defaults. And that was as good as a default because it moved the asset into a default category, and you had to deal with it in your CLO book. So today, we're much more focused, you know, in anticipation of a next cycle of how to manage defaults and what to do in documentation, how to prevent some of the trapdoors from appearing in the sponsor's arsenal. And it's all about protecting capital. In our business, what people forget is there's two ways to make money. And the upside is getting your money back. We're not generating 2, 3x, 4x your money, MOICs, where, you know, we can get rated as superstars in PitchBook. We just, if everything works, we get our money back. So then the question is, how do we differentiate ourselves and generate alpha for LPs? Well, one way to generate alpha is to generate a wider spread, fee income, spread income, and that's hard to do because that's all market-based. You know, we're competing in deals, and we're competing against each other and others, and the sponsor market's pretty efficient. They're going to negotiate to the lowest common denominator. So one way is spread, but there's a limit to what you can do on spread. The other way is lose less money than your competitors. And so that's the other side of the coin. Either make more money or lose less. And if you assume that there's a 2% default rate, let's say over the last 50 years, and private credit generates a 65%-ish recovery rate, well, if we generate a 1% default rate and generate an 80% recovery rate, we've just picked up 100 basis points over our peers. So that's what I think people are becoming much more focused on now, because it's all about track record in terms of raising capital and platform. We play baseball every day. I tell people in our business, we've got a scoreboard. Every quarter, our performance is on a scoreboard, and it goes to the insurance companies, it goes to the pension funds, the consultants, and everybody sees it. So we have to be very, very focused on generating the right type of return, but also on risk mitigation. And that's a whole different topic of discussion.
Well, Ted, you're into a great topic here, and we believe default rates in private credit are going to go up, right, as you go through a cycle. I mean, we have 30 years of history of default rates in syndicated markets. When you look at high yield, the average high yield credit is $1 billion of EBITDA, and it's 4 times levered. And we know what the default rates have been over 30 years. They've been closer to 3%. You look at private credit default rates, they're marketed as 1.5%, right? The companies are smaller. They're more like 50 of EBITDA, $50 million. They're more levered, more like 6 times. There's no way that this entire $1 trillion-plus asset class is going to perform that differently from a $1 trillion-plus high-yield asset class over 30 years. There are a lot of things that, across the board, the big lenders in private credit get right. The documents are better. They're not just like a little better, they're way better. The underwriting process is better, but default rates are still going to go up. And that's okay, as Ted was pointing out, as long as there's enough return to justify what that real default rate is going to be over time. And as long as the recovery on that default is also manageable. And so that comes into not just having documents that are good, but using them, using that to mitigate the recovery, right? Using that to actually manage through with the sponsors. And I think we see differentiation in that. And those are all things that can differentiate the private credit space going forward differently than it has in the last 10 years when you've been living in this no default environment, but it's also been an environment of immature portfolios, right? To another baseball analogy, right? When you've got a bilateral loan, the batter is also the umpire, right? Like, this is not new to credit. That was the same thing for banks when bank loans weren't syndicated 20 years ago, right?
I'd ask you to think about one thing, though, in your comment, and just talk about this. High-yield debt is an investment-grade tradable credit. So when things go bad, what we've seen is guys sell. And what happens is there are CUSIPs. So you sell that credit, and you get someone who buys the credit at 90 cents, at 80 cents, at 70 cents, at 50 cents. And you've got a bank group or a credit group that basically is a food fight. Private credit, on the other hand, is we're single lender in 85, 90% of our transactions. We may be a dual lender with PGIM or with Goldman or somebody like that, but we control that credit. That credit is not getting sold in the market. And what happens is when that credit gets sold in the market, in the high yield market, the reason why the default rates are higher is because there's a forced default, because what happens is that credit files bankruptcy. You get a lot of players, and everyone's angling then to make money on the distressed piece, to trade it, but more importantly, the company then forces a restructuring, and a lot of that credit gets turned into equity, which if you're a credit lender is not a great thing, because you lose your income. If you're a distressed investor and you want that to happen, and you take more of a private equity view, that's good. But in the private credit business, bankruptcies and conversions to equity are a bad thing. So I'd ask you to comment on the fact that the default rates are much higher because they're forced default rates in high yield as opposed to the private credit market.
But I do think there is a difference between a payment default and a covenant default, right? So you made the comment about big companies, right? Big companies can be levered, too big to fail, and we've seen that that's not the case, right? These companies have gone through bankruptcies, these big companies. And if you actually look at some of the analysis we've seen, is default rates are very similar across all the markets. BSL upmarket, lower market, mid-market, right? About the same. Recovery rates are what matter. And recovery rates are significantly higher in the middle market than they are in the upmarket and the BSL. Why? Covenants, right? Covenants. BSL upmarket, Cov Light, incurrence tests. So when are you invoice? When the company needs to borrow. When do they need to borrow? When they have a liquidity problem. You're catching a falling knife, right? Private markets, middle market, you have covenants, maintenance. You're seeing the progression, the downward that's happening with the company. You can reprice risk, right? You can monitor it more closely. That's going to improve your recoveries in that space. So we talk about defaults and what are defaults. It's recovery rates where you should be focused.
But is the question we should be... Oh, no, go ahead.
No, look, I agree. I mean, we're talking about default. What really matters is recovery. And it's clear that when you have a syndicate of lenders, BSL, just the time it takes for that syndicate to come together in a committee, the cost, and also the governance going forward as they take over a business, has nothing to do with how you can make a decision quickly if you're the sole lender, or if you're part of a very small group. And by the way, we've seen that during COVID, where the ability to move fast, to provide a solution within a couple days to a management team and a borrower was, may have been the difference between, frankly, that company surviving or not. I think where I would politely disagree is that, the stats we're looking at, the stat I've given you about Europe, 75% are small to mid-cap companies, the ones that have gone through a debt-to-equity swap. Why? Because they're less diversified. They're not as global. They're not market leaders if they're small companies. And so, I mean, the stats that we're looking at, the facts are that, these kind of equitization are happening faster. And as we speak, as I said, half of them happened last year in those smaller companies. Now, what matters is recovery. What you do with those companies when you own those companies. By the way, that's something that allocators, when we go around the world and we talk to LPs, ask your GP, what do they do? Do they have the capabilities to own a business? What would they do if they were to own a business? Go through that. I think that's going to increasingly be a differentiator.
But recovery is fundamentally a backward-looking exercise, right? And to your point, we haven't really been through a cycle here. And I wonder whether the question, I hear a lot of people talk about their default rates and brag about how low their default rates are. And I just wonder if the better question isn't waiver rate, amendment rate. We've seen a lot of these start to pay in kind, right? Some of these BDCs have 15, 20% of their income coming in paper.
But it's senior secured.
But it's senior secured, so everything's
so
fine. And by the way, they have a requirement to pay out a lot of their income in cash no matter what. So I don't know. Maybe explain kind of where we should be thinking about the risk, given that, to everyone's point, fewer forced defaults, you don't have a really loud syndicate, you're not going to have these sort of foot faults, but there are some odd incentives to perhaps pretend that things are better than they are.
Yeah, I'd love to comment on that. I think you can look at public BDCs and see how much of their portfolios are picking. Today, Barclays did some interesting analysis, which showed 8 to 10% on average, and as you've pointed out, some as high as 20. And yes, probably the private market has taken some of the defaults that would have occurred in the broadly syndicated market. But I think investors should be concerned today in the senior loan market. If you're invested in that market, you're second lien right now. The first lien just hasn't been created yet because of the holes in the covenants. These things are like Swiss cheese. They have holes, and managers are going to go right through them. You're starting to see that, taking assets out of structures, the ability to put covenants on adjusted EBITDA. I mean, there are things right now that are happening, and it's why a number of managers are hiring now lawyers and restructuring folks, which we've all had on staff for many years preparing for this. But I think the broadly syndicated market is going to be prime for some of this too.
But what's some of that sort of kind of creditor on creditor violence that you see a lot in the syndicated market? We haven't, I don't think, totally seen that yet. It seems like no one seems to want to really throw the first punch in private credit. It's been a pretty collegial place. When does that start to change?
No, you haven't had to do that in some cases because there are unencumbered assets in these capital structures. So if you are coming in and providing that first lien capital, you don't need to pull things out. You can take things that aren't a part of that and do it in a more friendly way, I think, today. But you're going to start to see more because that's the reality of the lack of covenants in that market over the past 10 years.
I do think though it is different than the broadly syndicated market, because you are talking, like Ted said, there's 3 or 4 of us together in a group, and we, you know, I don't want to say, maybe I live in a utopian, naive world, right? But we do recognize that you're our partners in this, and you want to figure this out together. And it's not trying to get the better of another lender that you're partnering with in that group, a credit lender. But in a broadly syndicated, there are so many. It's easy to layer on more debt on top of you, or to put yourself in that situation. So I think they're different markets.
They are. And I mean, I think last year the number was something like almost 50 deals across high yield and leverage loans that did one of those, I call it a selective default, call it a distressed exchange, right, that did one of those liability management exercises. And it is because of the documents. The documents across syndicated bank debt, and it is the case looking backwards, and it hasn't really changed much yet, looking at how documents work today. They have significant holes in those documents that allow for additional debt to be raised structurally senior to the bank syndicated market. Danielle's exactly, you said it best. You are second lien where the first lien hasn't been created yet. And there's the ability to move assets outside of that credit group. We think is mostly going to be a syndicated market thing. And by the way, it is not totally an accident. I mean, sponsors borrowing in those markets know the basket capacity they have. They certainly know it now. And that's part of the optionality that had been created in those capital structures. And should syndicated lenders, should CLO underwriters ask for better documents and require them? Yes. Will capital markets have that long of a memory? Look, we'll see. But I think it's going to mostly be there. What else will happen, though, that we think is interesting is that private credit will, as 6, 7, 8, 9 times levered businesses mature, will bring in other types of solutions. But it's not going to be like syndicated markets where anybody can come in from the outside into that capital structure. It is going to be a club negotiated solution. And in a lot of cases, it may be those same lenders that provide some different type of capital to solve it. In some cases, we think it'll be some outside lenders. I mean, this is something we've had a dialogue around. The company's over-levered. There's got to be a solution here. If the sponsor doesn't want to put in money, somebody else can put in junior equity capital into this business. And that's going to have a cost to the sponsor, but it can help delever things and can help create a par recovery for the senior lenders. By the way, those same types of deals happen in syndicated markets. They just have a lot of other nastier options because of the holes in the documents.
That's one of the biggest opportunities in the market. What we're seeing is that this vintage of deals that were done in 16, 17, 18, pre-COVID, pre-interest rates, which are effectively, and I'm now focusing more on the good companies, bad capital structures. That creates a huge opportunity for the private credit funds or investor strategies that can go either junior debt or more opportunistic. Sponsors that did those deals in that vintage are effectively sitting on almost zombie capital structures. These are older private equity funds, so the ability for the owners to inject significant amount of equity is fairly limited. We're now in discussion with sponsors where they effectively have to choose which companies they're going to inject equity in and which other companies they're likely to let go. Maybe the mark, is not taken yet, but certainly that alone creates a huge opportunity. On the junior side, we're seeing it. Maybe you plug into some peak, some holdco peak, you delever, hence you can refinance your first lien. And then you create optionality for the owner, or potentially to do something a bit more structured with some equity upsides. That is something that we've seen for the last 2 to 3 years, frankly, and it's only getting bigger as an opportunity.
Ted, you were saying that there's 2 ways to make money, and thinking you'll get another 10 basis points of spread over someone else is probably not the best one. Spreads have come way in, things are awfully tight. There's a sense that there's just too much money chasing too few deals, and that doesn't usually bode that well for asset quality. So how do you think about the deals that are being done today?
Listen, our business is as competitive today as it's ever been. Spreads have come inside. It's a function, I think, of two things. One, deal flow is down. The M&A market, for those of you that play in this space, we're probably 50% today of the M&A market, 2021. So that's one piece of it. Higher interest rates, I think, have caused PE funds to hold companies for longer. IRRs are going down, multiples of money are going down in PE because of time. And PE multiples are down. When interest rates come down, PE multiples go up. Everybody's been hoping that Powell's going to lower rates. There were supposed to be 5 or 6 rate cuts this year. Last year this time, it's not happening. Inflation is not under control yet, so we don't see that this year. So if that happens, deal flow is going to be at a premium. So the good deals in the marketplace, everyone's interested. The bad deals, people are staying away from. So there's a tremendous amount of price disparity in transaction finance today. But spreads are high. If you look at SOFR today, we're at a 5.25, 5.30 SOFR. We haven't seen that in the last 20 years. So if you take it, our base rates, returns, are still pretty good on an absolute basis, 10%. Even at 500 spread, 5.25 SOFR, we're looking at 10, 11% unlevered yields in private credit. And you think about that, if an insurance company has a 5% hurdle for their annuities and life insurance reinvestment assumptions, pension funds maybe 6 or 7% to cover their benefit costs, you're generating 11% unlevered return. And many of us take our funds and back-lever our funds with credit facilities. We do that for many of our funds at 1 turn of leverage or so. So I'm generating a 14% gross return, even in today's competitive spread markets. And if you take off a point and a half for costs, administration, run the fund, we're paying out a 12.5% return on private credit to institutional investors and to high net worth investors, as my competitors are. That's a pretty damn good business. So, you can bitch about the rates a little bit, the spreads, but I can't do too much because it's a pretty good business to be in today. The challenge is deployment, more so than, returns. Deployment is tougher. If you look at lots of the private credit funds in Europe that have been raised, transactions are down, lots of capital has been raised. US, the same thing. So, we're focused on ways to deploy capital. And what we've done as a firm is kind of move into other niche areas of private credit. Everybody talks about private credit. You think about what's private credit. Private credit is leveraged finance, backing private equity sponsors to buy companies. But private credit's also real estate private credit. It's litigation finance. It's NAV lending. It's asset-backed receivable lending. It's venture debt. It's healthcare lending. It's software lending. So we've created a pretty diverse box so we can pick and choose the best of each box and try to generate alpha in this kind of tight market.
You mentioned the spreads, but if you step back, back to the TLA, TLB comment. In 2006, a high-quality company would finance itself at 225 over TLA, 250 over TLB. Today, I would say that same quality company in private credit hands would get financed at 450 to 550 over plus fees, right? So by historical standards, the spreads and the absolute yields are still very attractive. And now we've been spoiled because in 22-23, given the dislocation, you could effectively finance those companies at 700, 750 over plus fees on top, 13, 14% unlevered. That is not normal for the type of risk that we're taking on this type of companies. But by historical standard, I would say the spread, the yields are still very attractive. Yes, there's more competition, but on the other hand, private credit is also extending its market share and its penetration. Why? Because we talked about it. The quality of the product and the solution for the borrowers is now kind of being validated. And I agree with you. I think private credit is way beyond direct lending. Direct lending is actually probably a small part of private credits, whether it's what you mentioned or asset-backed finance, private investment grade, which is probably the largest addressable market there is. So you can apply that playbook to other verticals within private credit.
Reminder to the audience, we've got about 10 or 11 minutes left, and if you want to submit a question, you can scan that QR code and it'll pop up here, and I'll ask. A quick show of hands, who uses NAV loans?
Sorry, what?
Who uses NAV loans you do?
We have a partnership with 17 Capital that does NAV finance. Mm-hmm.
And how do LPs in general feel about this?
I think it's mixed. You tell us.
Anyone in the audience?
Where we see a lot of value is actually when you're using these NAV loans to improve a portfolio company. You're injecting equity into a company because the fund has reached its life, they can't call capital. You're doing something that's improving the outcome for LPs. If you're just using the NAV finance to pay out distributions, you may be taking undue leverage on the entire capital structure. That's an area that I think gets a little bit more murky. We also see sometimes fund managers want to launch a new fund, and they want to allow LPs to participate in that. But since distributions have slowed, they can actually do the financing for that. So I think it's a broader market than sometimes it is made out to be in the press.
Sorry.
More Hamilton Lane, not you.
Sure.
We're not using NAV loans. We have a very large NAV loans business, but we're not using NAV loans ourselves. Yeah, on the bank side.
Yeah. I want to go back to something we were talking about earlier with retail and distribution, and eventually someone will crack this, and there'll be some sort of shakeout, I think, particularly on the RIA side. But retail have different expectations about liquidity fundamentally, and you can tell them all you want that this is not a liquid product, this is not a liquid product, and then when they get gated, they get very upset, and the whole industry kind of takes it in the teeth for a little bit. So I don't know who's sort of thinking about this, but I'm curious, sort of, even if you can get the logistical distribution, how do you get the product fit right, and how do you make sure that these are products that are bought, not sold?
Good question. For a while, the industry had a bad name because a lot of these products were sold. A lot of these independent wholesalers pumped the products and sold the products out into the marketplace. Some of those companies got in trouble, some had performance issues, and the buyers today are much more sophisticated. A lot of the RIA community acts like institutional investors today. They have their own directors of research, they have their own directors of alternatives, and they've been able to cull the product selection pretty well. And we're competing today in the retail channel just as heavily as we are on the institutional channel in terms of consultants and due diligence and metrics and returns. A lot of the sales are made through platforms today. There's the wirehouse platform, which are the Merrill Lynch, the UBSs, the Morgan Stanleys of the world, and then there's kind of the large RIA channel, which are the money managers, and then there's kind of everybody else. And we've tried to approach it as three separate markets. The wirehouse market, you're marketing basically to Morgan Stanley. The independent RIA channel, you're marketing to these very sophisticated registered investment advisors that sell the product basically to their clients. And then there's the direct going to the high net worth individuals. And I think the product today is a very much bought product. The risk, though, is what you said, is that the retail market is much more focused on liquidity. And we have illiquid products, basically. So we have to make sure that we manage those portfolios in a way that creates enough liquidity to cover redemptions. Some really smart, large Wall Street investors learned some bad lessons recently when it came to liquidity, where they had a run and they couldn't redeem. So they shut down funds. You've got firms like Blackstone shutting down funds, and all of a sudden people say, well, I'm not going into one of their funds anymore because they were shut. Well, they shut funds down for a year. That was like the best marketing tool that ever happened to our firm because all that money came to us because we said, we're not shutting a fund down. That's ridiculous. So I think that's one of the biggest concerns. If there's a turn in the economy, the people in our industry that are managing these high net worth retail funds have to manage those funds in a way that creates enough liquidity to be able to fund those redemptions.
I do think you also need the wealth managers to be able to explain to people, and they don't, and they may not even know themselves. This is still a new asset class for them. I have friends that are in that space, and they come to me and they're like, "So tell me about this." I'm like, "Well, it's not really that liquid, so don't give it to someone who's 80 years old, right? Like, don't put it in their portfolio." So there is an education process because it's a newer asset class, it's a newer security.
But by definition, it's a less liquid asset class, right? And so maybe for some people, there's something to do around the edges here, but there's something to asset liability matching. We've seen enough different funding structures for credit over the years that have been open-ended. I mean, look at what happens to loan and high-yield mutual funds in a cycle, right? I mean, that's the most liquid end of the asset side of the balance sheet, and what happens to those funds when defaults are coming, the economy turns. An asset class with this liquidity, I don't know, it's kind of prone to accidents if you put it into a liquid open-ended structure.
And I think there's a balance to be had amongst your LPs. We think that's a very powerful, by the way, source of diversification. We're active in the US, we're also active in Europe. But we need to set the right balance between institutional capital, wealth management, ultra-high net worth, and retail, right? And the issue is that if you rely too much on one, and in particular on one that needs liquidity, then as we discussed, during a crisis environment, you may be forced to do things that are unnatural. The other thing is that if you rely too much on this source of funding, you may be forced to deploy a bit faster than otherwise you would want, and that's why we're focused on it. We're careful. We want to strike the right balance here to never be forced to deploy.
A lot of this industry's growth is fundamentally regulatory arbitrage, post-2008. Not that you all aren't talented, interesting people doing interesting things, but it wouldn't work if the capital treatment of these things had not changed pretty dramatically at the banks. I don't know, is there a sense that regulation is coming for all of you, too, that it's been too good for too long to kind of be out there on your own, doing stuff that wouldn't be allowed anywhere else?
Well, I work for a bank, so I'll let my panelists comment on that, because I think we've had our fair share of regulation.
I think regulation for banks, I mean, we saw it a bit. What I think is one of the more exciting areas that's going to shake out of that and that you're starting to see is asset-backed finance. And we've mentioned that on this panel a bit. I think it creates more of an opportunity for us to look at different unique structures, whether it's pools of loans or revenue streams, and participate in this $5 trillion market that used to be more of a bank and insurance market. And now there's an opportunity for us to play in a big way there.
Yeah, I agree with Danielle. I mean, look at what's happened to banks in the last 12 months, and I'm not sure that I'm not sure that that's the risk to be concerned about, right? I mean, we're seeing more assets coming out of the banking system as a result of the challenges that have propped up than anything else. And I think a lot of our industry is built on finding those areas, not necessarily regulatory arbitrage, just inefficiency that's created in the system between what's happening and what the government ultimately puts rules in place for that drive assets out of those systems, that drive capital, access to be inefficient.
I think regulation exists to protect a group, whatever that group may be. And if you think about it, regulation for banks exists to protect depositors. That's why regulations exist. It's not to protect the borrowers. It's not to protect the companies. It's to protect depositors. What private credit has been able to do is achieve now a global finance process without touching depositors. There's no depositors in our business. The investors are institutional investors, which is exactly what the regulators intended in 2009 and 10 when they created Dodd-Frank and changed the capital requirements for banks in the US, and then Europe followed and other areas followed. They created capital regulations where it was unattractive to put these loans in the banking system Not because the banks didn't want to do it. The banks made a ton of money doing this, but because depositors ultimately would have to pay the piper if the banks failed or if there's a problem like we had in the financial crisis.
I just think the challenge a little bit is that on one hand, you say these are grown-up investors who are accustomed to illiquidity. They are institutional. They're here for the long term. And then you say, we got to get into retail. We have to figure out how to do this.
They're not sympathetic parties to protect.
I think I do. Well, you know, debt investor, I always look for the downside, right? I think as soon as something happens to Main Street as a result of the retail investors democratizing private credit, as soon as that happens, that's when you'll see the regulators come in.
I also think that there's a need for us as an industry to own the narrative and do a better job at explaining the risk and be proactive about the narrative as opposed to the narrative being served upon us.
Perfectly timed. That's it for the panel. Thank you all for coming. Thanks for the great discussion, everyone.
Thank you.
Thank you.